So I guess I'll go first. I'm Tom Yang. I'm a managing director and associate general counsel in the legal department at Bank of America. I cover equity, I've been covering equity capital markets at B of A for about 20 years. So.
My name is Porter Loud. I'm a partner at Baker Tilly in our national office, where I focus on technical accounting and SEC regulatory matters. And prior to rejoining the firm, I spent 3 years at the SEC in the Office of the Chief Accountant.
Hi, Dave Azarek. I'm a partner at Simpson Thacher. I head up our investment banking practice. So cover anything from equity, debt, anything in between. I've been doing this for about 20 years.
Larry Mazza, I'm president and CEO of MBB Bank. We focus on fintech.
Paul Munter, I'm really nothing, but I think I was invited because I served as the chief accountant at the Securities and Exchange Commission for 5 years, departed there about a year ago.
Craig DiDomenico. I help run the capital markets business at Stifel here in New York. Sector responsibility for industrials and consumer most of my days. And I'm the lone investment banker up here, so I'm generally creating the problems for the rest of the panel. So I'm sure they'll put me on the spot.
That's perfect. Hi, very nice to meet you guys. Thank you for a quick introduction. So let's start by grounding the conversation. Over the last few years, we have seen everything. Regulatory shifts, market volatility, new technology, evolving expectation for transparency and all hitting at once. So I would like to open with a broad but important question to set the stage for the rest of our discussion. So Paul, first question will go to you. From your perspective, what makes this moment a new era in capital markets regulation?
Yeah, let me do some quick level setting with respect to the Securities and Exchange Commission. As probably most of you know, the SEC has a three-part mission. One is to protect investors. Second is to ensure fair, orderly, and efficient markets. And third, to facilitate capital formation. And there's always a question at the SEC in terms of how heavily do you put your thumb on the regulatory scale? And obviously there are different perspectives, and historically those perspectives have divided along party lines, with Republicans tending to favor less on the regulatory side, Democrats tending to favor more on the regulatory side, recognizing that that is an overgeneralization, but historically that's what we have seen. When Congress created the SEC, it did so with an intention that the SEC would be composed of a bipartisan membership. So there is a chair, and then there are 4 commissioners. The commissioners, those 4, can have no more than 2 from any party. So generally 2 are going to be Democrats, 2 are going to be Republicans, and the chair will typically be from the party of the president. Well, what's happened over the last year is that yes, there are 2 Republican commissioners. Yes, there is a Republican chair. But as the Democrat terms have expired, no candidate has been put forward for consideration by the Senate for confirmation. And so the commission is operating with 3 Republican commissioners, which means obviously there is no real diversity of viewpoints at the commission. And the viewpoint, the perspective is to try to find opportunities for rolling back the regulatory regime where those opportunities present themselves. But what has also happened is there's a bit of a dynamic because the commission still has to follow the Administrative Procedures Act in order to do rulemaking, which takes time and putting proposals out for comment and the like. So they've moved with a lot of staff guidance over the last year to signal an appetite for less enforcement, less rigorous oversight regime, and the like. But that's also coupled with the fact that the staff at the commission is down from what it was 3 or 4 years ago, roughly 20%, and there was a public report on this about 2 weeks ago. So what that means is two things. One is a lot of the work of the commission, notwithstanding technological tools available and the like, is still very human driven. So if you have less staff, that means it might take longer to get through filings to be reviewed, for example, and things of that variety. And then secondly, as some staff is replaced, you're changing the experience level of the commission, which makes predictability of comments a bit of a crapshoot, because you're not really sure whether the new staff does not have as much experience as a lot of the staff that has left. And so you get a lot of inconsistency in terms of what kinds of comments, how many comments, and the like, that leads to, like say, some uncertainty in the regulatory environment. And I know we'll come back to rulemaking in just a minute, but while staff guidance can be useful for some things, staff guidance can be undone as quickly as it can be done. And so if you want to put in place more permanent adjustments to the regulatory requirements, that ultimately will require some rulemaking.
Appreciate it. Yep, makes sense. Larry, I would love to ask the same question, because, like you as a CEO of the company, just kind of from your perspective, what do you see?
Yeah, so January 2025, the world changed dramatically for regulatory environment, especially in the banking world. So what we've seen is a dramatic change from a very complex regulatory environment to one that has backed off dramatically, which has allowed us to grow again. We've had 3 years of consent order. We did not ever receive a consent order, but 22 fintech banks in our area received consent orders. Very difficult regulatory environment, very difficult to grow, very difficult to add to the economy of the United States. But now the new environment has been much, much better. We've been able to grow, we've been able to contribute, we've been able to help companies grow, which has been a dramatic change in regulatory environment. At one time, we were labeled what was called a complex bank. We're no longer labeled that, which makes our regulatory environment change as well. We went from 16 examinations a year, 16 to 1. So a very dramatic change, and that's what I'm talking about when you see this environment. So it's a great environment for companies like ours to grow, and we're pretty excited about it.
Indeed. I don't think anyone will be arguing that companies entering market today face a very different regulatory environment than a year or two ago.
Yes.
So with that in mind, Craig, I'll go to you with the question: what is the single most important regulatory trend companies preparing to raise capital should understand right now?
Yeah. I mean, obviously, we're blessed to work in one of the deepest capital markets in the world, and clearly we've seen with what's been going on with geopolitics is a continued flight to the U.S. markets from European companies. So I think one thing that we've been spending a lot of time with is just making sure that they understand what it means to be public in the United States, and what our processes, what our requirements are, and whether or not there are shortcuts or not that are regulatory appropriate, making sure that those companies understand, what that means, and what our processes, need to be, so that we can continue to support companies. Clearly, when we talk about trends, definitely this is going to be an IPO market of larger cap, but obviously we continue to list a lot of micro cap businesses, and I think we continue to see, like we saw a little bit in 22, a variety of ways for companies to get public in a more relaxed regulatory environment. And I think as a result, we're going to see a very big increase in number of listings. So as I think about some of the things that are driving, and I'll let Tom speak to specifically from his lens of the regulations, but in terms of level of activity and level of discussions, there's just this massive unlock. And a lot of that is not just deferred backlog, but it's ultimately it's new companies that are trying to get here. And part of that is being driven by what's going on in the political nature as well.
100%. Tom, same question to you, just from your perspective.
Yeah, I echo everything Craig just said. And full disclosure, Craig and I used to work together, so if I say nice things about him, that's why. But yeah, I also covering equity capital markets, I echo everything that Craig said. And to follow what Paul said, being an ECM lawyer, our primary regulator is the SEC, and I agree with everything that Paul said, that we're seeing a much different SEC under Paul Atkins than we did under the prior administration. It's still early days, but I would definitely say, and Paul, let me know if you disagree, that the pendulum has definitely swung from a more investment protection-minded SEC to a capital formation-focused SEC. Still early days. Atkins, I think, by way of example, one of the targets for Paul Atkins has been, I think, what he calls disclosure bloat. It's just getting crazy with these prospectuses and the 34 Act filings. So in mid-January, he put out a press release asking for comments on revising or suggestions to revise Regulation SK, which is the core framework for public reporting companies in the U.S. in terms of how they report things, how it looks. Coincidentally, the comment deadline for that was yesterday, and so it'll be interesting to see what comments come out of that. But he made it very clear that nothing's off the table. So I suspect you'll see some pretty interesting suggestions, and whether the SEC takes up some or all these comments will be interesting. The other thing I'll note is that it's been widely reported. We're expecting the SEC at some point to put out an announcement that proposes a reporting regime that goes from quarterly to semi-annual, much like you have in Europe. We'll see. That's not out yet, but I think the Journal put out an article a few weeks ago saying it's coming anytime soon, and we'll see what happens with that. If you rewind the clock to the first Trump administration, Jay Clayton, who was the then chair, put out a similar release on quarterly reporting, but it primarily asked questions about, from the market participants about what they thought about quarterly reporting, and didn't really give at the time much guidance of where the SEC may take action. I suspect, without having any personal knowledge, that what we'll see the SEC put out is actually going to suggest certain actions that they would like to take. So.
Yep. That makes sense. So let's build on that and touch a little on the legal and regulatory risk in capital formation. So David, the question will be addressed to you. How have recent rule changes affected the legal risk profile for companies raising capital?
Yeah, sure. So a couple things, and one just came up the other day. So one thing is, and it's all related to new companies and companies going public. As you guys have probably seen, there's been this flight to Texas, right? So all these companies are now incorporating in Texas because there's looser investor protection there. And the reason I'm laughing about it is because we have an IPO candidate that they were incorporated outside the U.S. They spent months reincorporating in Delaware. And then they finished reincorporating, and then somebody raised their hand and was like, can we just reincorporate in Texas now? And it doesn't work like that. You can't, it's too late. But that's certainly something that you're seeing, and we'll continue to see if more companies kind of, go along with that trend. Look, the other thing is, and this is what Paul and Tom were talking about, as you look at what the SEC is doing, enforcements are way down, right? So people feel fairly free in terms of taking certain actions where they might not in the past. What that has led to, and I think the nice thing is when you request certain no actions of the SEC, they're more likely to actually grant you these waivers that they have not in the past. So sometimes, not to get too much into the weeds, but if you acquire a company, right, and you're tripping certain thresholds, and all of a sudden you need acquired company financials, and you're like, oh God, that's going to take forever. Now my IPO is going to slow down, what have you. But they're only getting tripped because of some abnormality, whatever it is, something happened to the stock price of the company, and so one of the tests just kind of was so it's not that material, it's just one of the tests was just off because of how it's done. You can actually submit a letter to the SEC, and in the past we would say, don't bother, the rule is the rule, so if you trip it, you trip it. But now you can actually explain yourself, and you know what, that actually makes sense. We'll give you no action relief or kind of what have you. That's been super helpful because to Paul's previous point, the number of comments that you get, and you have honestly, you have no idea. Sometimes you get a bunch, and sometimes you get nothing, and sometimes you get very few comments, but they're very material comments. So you'll have 5 comments, they're all accounting comments, take forever to address. You might need to have a few calls with the SEC staff to kind of get through it. So that part kind of it depends on the deal.
You kind of see the same thing. You cannot predict these days. No. You have 2, or do you have 1?
Yeah, I mean, by way of example, we've got an IPO pricing later this week, and the accounting examiner dropped not a bombshell, but a big comment today. And we're like, we were going to request acceleration for pricing later, so we're scrambling right now, but it was kind of like out of left field, like where did this come from? So.
Yeah.
Yep, no, 100%. Let's stay within this legal and regulatory risk, and it's obviously when companies feel pressure, speed becomes a factor. So, Porter, question for you would be addressed: how should management teams think about balancing speed to market with regulatory readiness?
Yeah, absolutely. I mean, you guys teed me up perfectly. Accounting comments. Yeah. I mean, I think when you're balancing speed with going to the market, either in an IPO or a secondary transaction, I think one message that we're frequently sending to our clients is to make sure that you're involving the auditor as early as you can in the process so that they can help identify some of these more complex or risky areas that might be ripe for comment in, especially as it relates to accounting and the financial reporting requirements. The other thing I like to keep in mind in the context of all this change that we're experiencing, I like to remind companies about things that haven't changed, which is, there's a lot of anticipated rule proposals and anticipated changes, but currently there's still requirements to be a public company, right? So if you IPO, or even if you are already public, have been public for a few years, the issue we run into frequently on the audit side is controls, right? Management needs to certify that the controls are operating effectively. And that's a heavy lift. That's not easy, right? And so I think when you're going through an IPO process, I think being as proactive as you can on staffing up your accounting department and getting all those controls in place so that you're not paying for it on the back end, or even years later when it turns out there might be a deficiency or something like that, that I think creates more cost when you identify those things late in the game and on the back end of the process and have to correct them, rather than if you invest up front to kind of set that foundation to operate as a public reporting company.
No, 100%. Controls, controls, controls.
Yes.
So let's talk a little bit on kind of from the SEC priorities. I mean, let's zoom in specifically because it's SEC priorities shaping the day-to-day reality for issuers. So Paul, back to you. With question, how the SEC current priorities reshaping expectation for financial reporting and disclosure quality?
Yeah, I'll start first with the topic of materiality. If you think about, Porter was talking about application of accounting standards, there's a line in like the first paragraph of the codification that says, none of this applies if the items are immaterial. That being said, if you listen to some of the things that Chairman Atkins has said in a number of different forums, Kurt Cole, the chief accountant, has spoken about this, and has essentially said, you're perfectly empowered as management to make materiality decisions, and in particular, make judgments about what are not material items, and if that's the case, then disclosure is not required. Now, you're recognizing the reality, of course. You're also going to have to convince, if it's in the financial statements, you've got to convince your auditor that it's also immaterial, which may or may not be that difficult to do, depending upon the fact pattern. But I think that's helpful. But I do think it's very interesting because materiality is defined, number one, through the lens of a reasonable investor. But number two, within the confines of the total mix of information that's available. And if you think, we've heard throughout the day about the advances in AI tools and things of that variety. And so if you think about the tools that are available to investors, even retail investors, they have the power to digest a lot more information than they could have historically. Now, I don't know what that means in terms of materiality assessments, but I think that is part of the environment. But anyway, clearly the chair and chief accountant have been messaging about, think about whether something is or is not material in deciding what needs to be reported in the filing. Second is the PCOB board members are appointed by the SEC. And within the last couple of months, the SEC appointed 4 new board members to the PCOB, with 1 board member continuing. One of the mandates that's very clear that has been given is for the PCOB to think or maybe rethink its inspection process and in particular, I'll call it the grading of inspections. Now, you might sit there and say, well, I'm not the auditor, I don't care about that, but auditor behavior is significantly influenced by PCAOB inspection behavior. And so if there's going to be a dialing back in terms of heavy-handedness of PCAOB inspection processes and findings, that will have an impact on how the auditor is going to think about things and will be probably more accommodating. David, I think you just mentioned the enforcement side. Clearly, a rolling back in terms of enforcement by the SEC, and I think there will be a huge rolling back of enforcement efforts by the PCAOB as well. So while certainly egregious circumstances are going to be dealt with through enforcement, I don't think that you're going to expect to see the amount of enforcement actions based on misapplication of accounting, auditing, or internal control assessment as we have seen over the last several years. And then lastly, I think it was Tom mentioned the comment file related to SK and also SX for that matter, and mentioned also that we expect a proposal with respect to quarterly reporting in the near term. I think if you look at other things the commission has done, they've had a series of roundtables on executive compensation. It would not surprise me at all if we saw proposals to roll back some of the executive compensation disclosures. And I think we'll see a series of rulemaking proposals because, as I mentioned earlier, the way you drive more permanence to the regulatory regime is through rulemaking rather than relying too heavily on staff guidance.
Yep, indeed, appreciate. Staying with kind of on the discussion about SEC priorities, David and Porter, that probably will be a question for you guys. I'll start, David, probably with you, and Porter, you can jump in. The next question would be, for companies preparing for IPO uplisting, what are the most common pitfalls in financial statements, MD&A, or non-GAAP measures from your perspective?
So, I mean, one that I think no one cares about anymore is like we used to have all these comments about EBITDA and what goes into your non-GAAP EBITDA, and is something one time, is it not? I think people are over that ghost, and people kind of add back pretty much everything yet again. As long as you can justify that it's one-time-ish in nature.
Air quotes.
Exactly.
What's interesting is investors are more focused on it, and
yes,
and their regulators are less focused on it. So,
what ends up happening is like sitting from the underwriter side, like I can only make the comment so many times, right? But then like when the SEC just doesn't say anything, okay, like we're gonna move on, right? Like you've been overruled or no one cared, and so like off you go. I do think there is an emphasis on segments, so within your financial statement, just being careful how you're presenting your business, because as soon as it starts to look like it's more than one segment and yet you're presenting it as one segment, I think you got to look really hard at kind of how many segments you have, and if you get that wrong, that's an issue, and that's going to delay you for sure, because then you got to correct it, and that's a whole other work stream. And then the other one is KPIs, your key performance indicators. Some are GAAP, some are non-GAAP, what have you. But however you decide to market your business, and those are the key KPIs for your company, for your industry, what have you. I think some people forget that like whatever you put in your S1 later on, like that's what you're going to report on a quarterly basis as well. And it's very hard to then kind of raise your hand and be like, you know what, like our KPIs don't look good, so we're just going to stop reporting them. So that's important to remember as well.
No, I appreciate it. Porter, on your side, anything to add?
Agree. I was just going to piggyback on your comment on segments. I think we have seen that as an elevated priority. It's always been a priority, I think, of the staff, kind of in the comment process. But there was a new accounting standard released a few years ago that kind of reinvigorated some of the focus on segments. Probably the most common thing that we wrestle with our clients that are going public is debt equity issues, where they've got warrants or other complex financial instruments that haven't been scrutinized previously to the level that your auditor might expect them to be in a public filing. And so we spend many, many hours working through that. I was on a call earlier today with one of our financial instrument experts talking to a company about it just today. So if there was one accounting issue that I would point to that we see being a pain point, it's stock, preferred stock, warrants, any financial instrument you have out there, and making sure the accounting has been well thought through and robust for your filing.
Yeah, no, I appreciate it.
One other point on the segments, which I think is a really good point, is in addition to the new disclosure requirements, Porter, that you were talking about, but it's really useful to keep in mind whether your org structure aligns with how you're reporting segments. Because one of the staff will go out and they'll look at your org structure, and you say you got the senior vice president of this and senior vice president of that. It starts to look like maybe those things ought to be segments. So really important to think about that, not just through the lens of the accounting requirement, but does the org structure match up to that?
Yep. I want to look quickly kind of ahead, and Tom, I probably will start with you the next question and jump right to you. What regulatory developments do you expect to have the biggest impact over the next 3 to 5 years? I know it's hard to predict, but just from at least from your perspective, you kind of go top impact. What
Well, notwithstanding that, I'm still going to give you a cop-out answer, which is, it's just, in all seriousness, it's just early days. I think Atkins was sworn in. And look, once again, looking at this as the SEC, as the primary regulator for equity capital markets, Atkins was sworn in almost exactly a year ago. And then more importantly, the current director of Division of Corporation Finance, Jim Maloney, who came over from Gibson Dunn, he's only been sitting in that seat since October. So I think the Reg SK thing is interesting. We'll see how that plays out. The semi-annual reporting thing that I discussed, we'll see how that plays out. But I think now that Jim's been in the seat a few months, we'll see him working with Paul to try to propose innovative rule changes that will make capital formation easier. I know from speeches by both Atkins and Maloney that they're looking for suggestions that more on-ramp suggestions. So if you think about on-ramp, you go back to 2012 when the Jobs Act was adopted, and it created all these really new innovative things that you can do in IPOs. For example, testing the waters didn't exist before now. And over the years, the SEC has expanded the original application of testing waters to pretty much any company can rely on it, and other things like confidential submissions. So we'll see what they're thinking about in terms of on-ramp suggestions, but I suspect in 2026, the remainder, we're going to see some interesting proposals, subject to Paul's comment that they're still short-staffed. So you need people to draft these rule proposals, and they're down almost a fifth from when they were a year or two ago. So that'll be a governor on rule proposals, but we'll see.
Got it. No, I appreciate it. Greg, anything from your perspective there?
Yeah, I would just say when I used to work with Tom, I used to have a full head of hair. So what we all
It's not
know,
my fault, I swear.
Yeah, what we know is things will constantly change. And I think what we spend the most time at our committee level is focusing on what practices and processes we want to follow in order to underwrite specific situations. And we're always offered the opportunity to stretch those boundaries. We can look at the wave of SPACs and when they came back and there's SEC scrutiny. The reality is we never really changed the way we looked at those vehicles, whether other firms did or not, and I think that's important. I would echo Tom's comment about test the waters. In the last 20 years, that might be one of the biggest changes that happened. And the reality is we always did our best to put our clients in the position to win and to have as much information as they can. But the ability to do multi-rounds, test the waters with investors, meet up to 40, 45 investors before you have to hit that public button or make that decision. Or if you're a private equity owner and you're debating, do I go public or do I sell this company? The ability to really get out and have those detailed conversations, I think informs the board in a way that we really find valuable, because we obviously are in the business of providing optionality for clients that we're looking to monetize. So yeah, I mean, I think I'd echo those. I think that the quarterly reporting versus the reality is, my experience is whenever we had clients that came over that were relying on IFRS, we would always guide them to start to provide some level of guidance on a quarterly basis. That's just the way the U.S. investors used to buying companies. Whether or not that changes, that's hard to see and hard to imagine. I can understand the burden on companies would be dramatically different, and I guess will evolve with that. My guess is to the point about segment reporting, KPIs, there will be some ability to provide updated guidance, every 3 months either way, whether it's formally reported or not.
Yeah, I agree with Craig's comment that I keep mentioning this new rule proposal that's going to come out, but putting aside what the SEC proposes, how the market reacts is a completely different matter. So what are investor expectations? Sell-side research analysts at all our shops, they're used to basically every quarter putting out a research report on that quarter's results. So I think if you look at Europe as an example, I suspect you won't see like everybody rushing to start just reporting twice a year. But we'll see. We have to see, what the SEC puts out, then react to that, send comments, see what they adopt, and then the companies can figure out what they actually want to do.
Everything in specific order.
Yeah.
Agree with those comments. I was going to just mention quickly, one thing we've been talking about internally, just kind of guessing what the rule proposal might look like and how the market might react, is we're often, as auditors, asked to provide comfort letters that might include quarterly information, and how that might affect the comfort letter process. If a company has an offering that they're trying to do and the underwriters or other users need that comfort letter to be comforted, then it just will be interesting to see how the proposal
Because the current
impacts
framework's
that.
built
Right.
on a quarterly reporting system. So if you go semi-annual, what happens to comfort?
Exactly.
So that's a good point.
Exactly.
Yep. So now let's connect regulation with market itself. And Laura, I will jump to you with a question. How are the regulatory shifts influencing deal timing, valuation, and investor appetite?
Yeah, in 2 words, I would say it's go time. And the reason I say it's go time, you need to look at the history. So we look, Trump won, it was a good time. You look at it was very positive, the deals were getting done. You look at the Biden time, not so good. It's very difficult and challenging. You look now, you're back to Trump. Is it back to where you were in 19 and 20, the go-go years? No, it's not. But it's a good time because the real uncertainty is what happens in 3 years. So I think this is the best time that you have. This is the best time that you know. So I think as things continue to move forward, bar the geopolitical issues, it is go time.
Yep. No, I appreciate it. Staying on the market kind of dynamics, David, question will be kind of addressed next to you. Considering that due diligence becomes its own kind of battleground, are you seeing changes in diligence expectation from institutional investors?
Yeah, look, the short answer is no. In an IPO, obviously the investors themselves are not doing kind of the diligence. So we do the diligence, for the banks to underwrite. And the stuff that you see out of the banks, I don't think Tom, from a committee perspective, it's the same stuff. What do banks care about? Like regulatory for sure. Do you have any FCPA, OFAC issues? Are you doing business with Russia? Are you doing business with China? Those. And if you are, I think it's just elevated diligence. Now in the world of AI and all the cyber hacks and all that kind of stuff, that continues to. But that's been around for a while in terms of people caring about it. Cyber breaches, things like that. Otherwise, it's kind of I would say it's the same focus areas.
Yeah, and Dave, I would echo that. On that point, it's not just what the SEC puts out, but a lot of our behavior, and Craig, you probably agree with this, is driven by the threat of private litigation, which I don't see any reforms coming down the pike for that. And as long as that threat's out there, I suspect behaviors won't change that much. So I agree with that.
Craig, I'll jump next to you and maybe Larry. After that, kind of will be the same question because you can think. From my perspective, the main question will be what separates companies that execute successful capital raises into the environment from those that struggle?
Yeah, I would say, we talked about spending a lot of time just getting to know. I think on the diligence point, I think part of the reason why by the time we get to the public phase, we sort of have a sense is investors are getting to meet these companies 2 or 3 times. So they're getting to give us the no sign pretty early. So I think the reality is, processes are, I think they're more organized. I think they're spending more time. I do think we had a recent IPO where an institutional investor in New York, reached out to all the company's subs and was getting reference checks from operators. So we have seen a level of diligence and scrutiny that is reflective of the fact that a lot of, specifically on the IPO side, investors got burned pretty good in 22 and 23. And I think it's on all of us to make sure that we keep this going. If we have 150 IPOs this year, we want to have 200 next year, and I think that would be good for what's going down. I think that ultimately, I think it's definitely an era where we'll continue to see processes evolve. I think the buy side is going to be there and focused on it. But yeah, I mean, I think a lot of the comments you've heard already are reflective of that. And I do think that the second quarter is going to be one of the biggest dollars raised we've seen in a long, long time. And I think what we need to do is make sure that's supported, that investors are treated fairly, and that we're generating alpha, and that way we can continue the train.
Got it. Yeah. Same question. I think one, it's ironclad preparation. When you're going to the market, you're acting mature. As a company, you're bringing spot-on information. It's not mismatched. It's perfectly matched. You could count on it. It can be trusted, and I think that is critical. I think the other thing too is your team has a proven track record. They're executing. They're making things happen, and you have that type of team that investors are looking for. I think you're also looking for traction with visibility. That you're seeing revenue growth, you're seeing actions that show a mature company that people want to be a part of. I think also that clear path to profitability is there. You're showing it and you're executing. I think that's critically important. And you have defensible moats and a strategy that's executable that you can count on as you go forward.
Yeah, I mean, I think the last comment is, there's a theme this year of the larger IPOs, but at the end of the day, like, if you're deciding to go public, you're selling, 20% of the company, 30%, sometimes max 40. Like, the reality is you're retaining the majority of the company, right? So you need to find that alignment with your new institutions, and you need to make sure that your use of proceeds are really aligned from that perspective as well. And investors are generally, I think you're going to continue to see evolutions on some lockup provisions to make sure that there's good alignment. And I do think that obviously those companies that do come out and have a miss in those early quarters are going to be scrutinized and be in a penalty box. That's not as easy to get out of, and that should be on the underwriters, and we should be yelled at, and everybody. And things change and businesses change, but we need to do as solid of a job as we all can to make sure that the numbers that are coming out through the analysts are reflective of a reality that the market can accept, and then we need to do our best to try and meet those expectations. And I think that alignment will continue a really good supply-demand imbalance for the next few years. So I think that's right, and I agree.
No, I appreciate it. Let's widen the lens kind of beyond the U.S. and see kind of the global environment. And with that in mind, Paul, my next question probably will be addressed to you. How you, from your perspective, how global regimes such as European Union, APEC, influencing U.S. capital markets regulation?
It doesn't directly impact regulation, but it does impact corporate auditor behavior to the extent that you have footprint that extends outside of the U.S. For example, Larry, you were talking about the reduction of the banking regulatory regime in the U.S., which is helpful. But if you look at elsewhere around the world, whether it's Europe or the major Asian markets or the like, they're busily implementing Basel III requirements kind of around the globe, for example. If you look at climate disclosures, while the SEC has put its rule in abeyance for indefinitely, Europe is going ahead, and I know that they have reduced the requirements of ESRS, but that's not the same as eliminating them. So those are going to kick in for companies operating in Europe, cascading depending upon how you operate, but cascading over the next 3 or 4 years. Likewise, the markets in Asia, Singapore, Hong Kong, Tokyo are implementing climate and other sustainability reporting requirements in their markets. If you're dealing with an audit firm that operates within a global network, it's probably struggling with the fact that Globally, it has implemented the International Quality Management Standard, ISQM1, whereas in the US, it has implemented the AICPA Quality Management Standard, which is similar but not exactly the same as ISQM1 for its non-public clients, and it's still got the old QC standard for its PCOB registered audit, because the PCOB has deferred the effective date of QC 1000. So you've got audit firms trying to figure out, well, how do we navigate that? And again, as I mentioned before, audit behavior cascades back on companies. So I think there's a lot going on in the international space. It won't likely affect regulations here in the US, but companies that find themselves subject to requirements in multiple jurisdictions will find it increasingly difficult, because if you're not aligned in terms of trying to achieve compatibility from a regulatory perspective, it makes it very difficult for the company to put in seamless processes that can be replicated across borders.
Yep, no, I appreciate it. Staying on the global topic, kind of focusing, and next question, Tom Porter, I would like, in no particular order, to ask you guys. For cross-border issuers, what new complexities, opportunities are emerging?
So I'd say from the legal end, notwithstanding the deregulatory tone at the SEC that we've all discussed for the last half hour or so, the one exception I'm seeing, and let me know if you guys disagree, is the SEC's focus on foreign private issuers, or FPIs. Probably not surprising in light of the current geopolitical tensions out there with certain countries. But last June, the SEC put out a concept release, and it indicated that right now FPIs are accorded certain accommodations from a reporting and its disclosure perspective. And the SEC, as clearly last June, questioned whether certain FPIs should continue to be afforded those accommodations. A lot of comment letters were submitted, and I think, like, for example, SIFMA, which is the trade organization for Wall Street, said a very short letter, but just pointed out to the SEC that, I think, Craig, you had said this, the US capital markets is the deepest, most liquid capital markets in the world. A lot of foreign companies choose to list here. I think, Craig, you were mentioning European clients of yours. Yeah. And that's a good reason, and that's a good thing. And so I think SIFMA, in a guarded way, kind of told the SEC, if you make this place an inhospitable place to list, New York Stock Exchange or NASDAQ, that's not necessarily a good thing. So, and I'd say a lot of law firms that submitted comment letters kind of question whether the current system is truly broken or not. So we'll see how the SEC reacts to that. The other thing that I'll just really point out and turn it over is that as of March 18th, the SEC has imposed Section 16 insider reporting obligations on FPIs. Now, right before March 18th, they gave some exceptions to a bunch of countries, off the top of my head, Canada, UK, EU, Korea. But if you're not one of those enumerated countries, you now have to file Forms 3, 4, 5s like any US company. So once again, if you're an FPI, the US is starting to look like a less hospitable place to list.
No, I agree. Piggybacking on what you said on the IFRS accommodations, I think both the chief accountant and the new chair of the SEC have certainly had a focus on those accommodations, and specifically on the IFRS Foundation using part of their funds and their budget to fund sustainability standards internationally. And so there is kind of an intersection of some sustainability politics with those accommodations, and how that plays out, we don't know, but that's certainly I think the thing that came to mind for me on the international front. One niche item that I'll mention as well is there is a focus also on variable interest entities that are based in China or have Chinese parent companies. It's definitely a hot topic.
And that ties into this FPI release that was issued last June.
Yep.
So.
I still have about 20 questions that I probably need to speak, considering we're running out.
But people want to get to the bar.
Exactly. We can continue the conversation. But let's bring it home with some practical kind of advice. Question will be for every panelist, and we kind of go in order. If you had to give one piece of advice to companies trying to stay ahead of regulatory change, what would it be, Tom?
I'd say just stay in touch with your lawyers. We've got some good ones up here, and your auditors. And just be nimble, because it is going to be a changing regulatory environment. And as these changes come about, you just want to be nimble with your advisors.
Appreciate it. Paul.
Yeah, I agree. I mean, I mentioned it earlier, but I think my piece of advice would be to involve your auditor as early and often as you can, just to stay ahead of anything. You don't want some accounting issue or audit issue to blow up at the end of an IPO process. You want to identify those things early. And last thing I'll say is I didn't give the same disclaimer you did, but I also worked with Paul for several years. And when he refers to the talented staff that are now shorthanded, I like to think he's referring to me, but you'll have to ask him that.
For the record, I didn't say anything when Paul said like, oh, if you're not auditor, kind of you don't care. I was like, I recognize there's some auditors in this room, right? Or ex-auditors.
Yeah.
You just got to be prepared. All these windows, not to steal thunder from bankers here, but like the windows are short. Regulatory, whatever the changes are, just got to be prepared. And I guess I got to tell Tom, I mean, to give the compliment back at you, you got to hire a good bank to do your IPO. And
I.e. B of A or Stifel, right?
Yeah, so the way I look at it is you can only control what you can control in the regulatory environment. The way we did it was through AI. We had 160 people in regulation and risk. We now have 90 because of AI, but we also have a much better job doing it. We had a person could monitor 30 transactions. Our Digi or our digital worker can monitor 1 million. And this is a day. So our regulatory that's what we can control, and our regulatory situation is much better than I think anybody in our peer group because of that.
Yeah, I guess the one thing I'd add on is, regardless of what the regulatory requirements are or are not, as you're thinking about your communications in the marketplace, you need to think about corporate reporting through the lens of communication rather than compliance with whatever the regulatory requirements are. And think about it holistically so that you don't have one group over here saying one thing and another group through another communication channel saying another thing, so that you're telling inconsistent stories about what your story is. So you have a consistent depiction of what the company is doing, what its objectives and strategies are.
I guess when I'm downstairs doing a bell ringing with a company that we just took public, I always tell them, welcome to the starting line. So if you think that way with your company, it is a huge milestone, but at the end of the day, the most important things are after that moment. So preparing to be ready for all the things that we discussed today and having good advisors, thinking like a long-term owner generally yields a good outcome. So appreciate everyone's time today.
No, I appreciate it, and we kind of ran out of time. Guys, thank you so much.
Thank you.
Very